Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, this is the second video of joint venture chapter, and in the previous video we have seen the concept as well as the methods of joint venture. And if you haven't watched that video, then please go watch that video first. I will put the link in the description below. Now in this video we are going to solve this simple problem of joint venture, and this problem would be based upon the first method, that is when separate set of books are maintained. That is when separate set of books are maintained when an accountant is hired by the co-venturers. Now who are co-venturers? Co-venturer means the partners in joint venture. You may call them partners or parties in joint venture. So these co-venturers will hire an accountant, and that accountant will be given the sole responsibility to prepare these three accounts. Alright? Okay. Now let's go back to the question. See here. Amit and Sumit entered into a joint venture, agreeing to divide the profits or losses in the ratio of 2:1. So here these two persons have entered into a joint venture. It is like entering into a temporary partnership. It is a temporary partnership which is created for a specific purpose, for a specific project. After the completion of that project, this temporary partnership would come to an end, and this Amit and Sumit, they will go their own way. They will not see each other again. Okay, this is what is meant by joint venture. It is a temporary partnership. If anyone asks you what is a joint venture, you tell them it's a temporary partnership created for specific purpose, and after the completion of that purpose, it comes to an end. All right, that is what is meant by joint venture. And now they have also agreed to divide the profits and losses in the ratio of 2:1. Okay, simple. And then Amit contributed 10,000 rupees and Sumit contributed 5,000 rupees. So of course they are going to do business. So now of course they have to contribute something, isn't it? So they are contributing capital, that is 10,000 and 5,000. Amit has contributed 10,000 and Sumit contributed 5,000 and deposited the same in a joint bank account. Of course the money will go to a bank account. Every firm has a bank account, right? Here joint venture will also have a separate bank account. Then it is said they purchased goods worth rupees 20,000 from Arish, paying rupees 12,500. So here they have purchased some goods from this person Arish, paying rupees 12,500. They have purchased 20,000 worth of goods but only paid rupees 12,500. That means still 7,500 is pending, and accepting a bill drawn by him for the balance, and for the balance they have drawn a bill. They paid for carriage rupees 1250, go down rent rupees 250, and sales expenses rupees 500. So here they have incurred some expenses for the business: carriage, go down rent, and sales expenses. Then they have said all the goods were sold for rupees 28,000. So all the goods were sold for rupees 28,000. They also met their bills payable on due date. So here there was a bill, right, of 7,500. So it is said they met the bill on the maturity date, okay, on the due date. Then it is said show the journal entries and the necessary ledger accounts in a separate set of books. So we will prepare the journal entries and also the necessary ledger accounts. Easy, right? So we are going to prepare, first we are going to prepare the joint venture account, and then co-venturers account, and then joint bank account. This is similar to trading and profit and loss account. Here we will find the profit or loss made by the joint venture, and then the co-venturers account. This account is similar to capital account, okay, partners capital account, and then joint bank account. All right. Okay, now let's solve this problem. Now, before going to the journal entries, let's see these two differences between partnership and joint venture, which are very essential for solving the problem. See, in partnership, what we used to do, in partnership, we used to divide the expenditure into two, as an expense and asset. The benefit of something which expires within 1 year, we used to call that as an expense. Like rent is there, salaries, wages, and electricity bill, telephone charges, all those items used to be called as an expense, because the benefit of something which expires within 1 year or which lasts for only 1 year. So those items we used to call as expense. But assets, see, the benefit of something which lasts for more than 1 year, like machinery is there, furniture is there, which lasts more than 2, 3, 4, 5 years, right? So those items are called as an asset. So we used to divide it. Yes, we used to divide the expenditure into expense and assets. But in joint venture, it's not like that. In joint venture, whatever expenditure is incurred, we treat all the expenditure as an expense. We treat all the expenditure as an expense because here the joint venture is meant for short duration. It's a short agreement which lasts hardly for 1 year, 2 year maximum. So here there is no future. Here there is future. Assets will go on for like 5 years, 6 years, 7 years, but here there is no future of joint venture. As soon as the work is completed, as soon as the project or the purpose of joint venture is completed, this joint venture comes to an end. So there is no future over here. So everything will be treated as an expense over here. Okay, keep that in mind. The entry for purchasing an asset and expense will be same over here. Okay, but here it is different. Here if you pay for rent, then it will be rent account to cash, right? Rent account debited to cash. And if you purchase an asset, then it will be like asset account to cash. But here the entry will be same. We will see the entry later. Okay, so here there will not be any asset. Here everything will be treated as an expense. Okay, and then another difference between the partnership and the joint venture, which is very essential, is that here in partnership proper records are maintained. Okay, in partnership proper records are maintained. You have to maintain all the accounts. See, we will prepare the journal, ledgers, trial balance, profit and loss, appropriation account, balance sheet, everything we have to prepare in the proper record. In partnership we have to maintain the proper records. But in joint venture, since this is only meant for short duration, only for 1 or 2 years, so here limited records are maintained. It is economical, right? Here it is only meant for short duration, so limited records are maintained. Only very few accounts are prepared, such as joint venture account, joint bank account, and co-venturers account, like that. So very few accounts are prepared. Here we will not open furniture account. If you are purchasing the furniture, we will not open furniture account. We will not open machinery account, like that. We will not maintain lots of accounts. Only 3 to 4 accounts. Only within 3 to 4 accounts we will finish our job. Okay, in joint venture limited records, and in partnership proper records. All right, that's the difference between these two. So these were the essential differences that you need to understand before solving the problem. I hope you have understood that. Now let's go to the journal entries. Now let's see the journal entries. See, at first what happened, at first this Amit and Sumit, they came together and formed this temporary partnership, this joint venture, this temporary business. And now to run this business successfully, of course they need money, right? Of course they need money. So Amit contributed 10,000 as his capital and Sumit contributed 5,000 as his capital. All right. So both of these co-venturers, these owners, have contributed into joint venture. So in total 15,000 cash is coming into the joint venture. So now where would this money go? Of course this money will go to the bank account of joint venture, which is called joint bank account. So joint bank account is increasing by 15,000, isn't it? Cash is coming into the business, so joint bank account is increasing by 15,000. And what is the other effect of this transaction? The other effect is that the contribution is made by Amit and Sumit, so their capital accounts are also increasing. The capital accounts of Amit and Sumit are also increasing. So bank account is increasing, joint bank account, and Amit's and Sumit's capital accounts are increasing. So what would be the journal entry? See, the journal entry is very simple. Joint bank account debit 15,000 because joint bank account is an asset account. So if it increases, you have to debit, and then you have to credit to Amit's account to Sumit's account. Why? Because these are capital account. The capital accounts are increasing. Capital accounts are increasing. Whenever capital account increases, you have to credit. So 10,000 and 5,000 will be credited to Amit's account and to Sumit's account. Simple, right? The first entry, asset is increasing, debit, capital accounts are increasing, you have to credit. That's it. Easy, right? All right. Then the next entry is purchase goods from Arish. Purchased goods from Arish. See here, specifically the name from whom we have purchased is mentioned. That means this is a credit purchase. This is a credit purchase. So you have to understand that. Just by seeing, you have to identify that here the name is given. That means this is a credit purchase. You have to pay extra attention over here. So worth rupees 20,000. Purchase goods from Arish worth rupees 20,000 and paid 12,500. So only 12,500 is paid on the spot, and the remaining balance is not paid. 7,500 is outstanding. Okay, it will be paid in the future through the bill of exchange. Now let's see what would be the journal entry. See, what would be the journal entry in the normal accounts? The journal entry would be purchase account debit to Arish. Yes, that is the credit purchase entry. Purchase account debit to Arish. But here we will not take purchase account because here we have to prepare limited number of accounts. We have to prepare limited number of accounts. So we cannot open purchase account. Instead, we will open a new account that is called joint venture account. Joint venture account, and this account would be similar to trading and profit and loss account. Here we will debit all the expenses and credit all the revenues. So whenever there is an expense, you have to debit the joint venture account, and whenever there is any revenue which is coming in, then you have to credit joint venture account. See the journal entry, you will understand. It's very simple. See, joint venture account debit because expense is increasing, purchase is increasing. Yeah, because of purchase the expense is increasing, so purchase account debit, that's the normal entry. But here we are taking joint venture account debit because to maintain the limited number of accounts. So joint venture account debit to Arish account. Now Arish is creditor, we have to pay to him in the future. So Arish is creditor, he's a liability account. So if liability increases, you have to credit by 20,000 because worth 20,000 worth of goods, right? So 20,000. And joint venture account debit 20,000 because here expense is increasing by 20,000. So whenever expense increases, you have to debit. Whenever liability increases, you have to credit. Simple joint venture account debit to Arish account. Okay, always remember in joint venture, in this first method, always whenever expense will increase, you have to debit the joint venture account, and whenever revenue increases, you have to credit the joint venture account. All right, so here expense increasing, here liability is increasing, debit credit. Next, here it is said Arish was paid 12,500. So now Arish was paid 12,500 and a bill of exchange was drawn on this joint venture by Arish because 7,500 is outstanding to Arish, right? So in future we will pay to Arish 7,500. So what would be the journal entries? The journal entry is very simple. See, Arish account debit. Here the liability was created, right? Here the liability increased. Here the liability was created. Now the same liability is being exhausted. It is being decreased. It is being cut off. Okay. So that 20,000 will come over here. Arish account debit 20,000. And how much did we pay? We paid him 12,500. So to joint bank account 12,500. Our bank account, our asset account is decreasing by 12,500 because we are making payment to Arish. Alright, so it is decreasing. So if it is decreasing, then 12,500 credit. Simple. Okay, so 20,000 debit, and then two bills payable. Now as I said, right, the bill was drawn by Arish on joint venture. So now that bill payable is also a liability which is being created now. So to bills payable account 7,500. Now in future we have to pay this bills payable 7,500 to Arish. Okay, so this is also a liability. So bills payable is a liability account, so it is increasing, you have to credit. And here it is an asset account, joint bank account, so you have to credit because it is decreasing, right? Asset is decreasing. Whenever asset decreases, you have to credit. And here Arish account is debited because this is a liability account, this is creditor account, it is a liability account, so it is decreasing over here, you have to debit. Okay, here the liability is being cut off, and then he is being paid 12,500, and then new liability is created 7,500, which is to be paid in the future. Simple. Arish account debit to joint bank account to bills payable account. It is very simple. And then what happened? And then you see here some expenses are incurred by the joint venture. See the carriage of rupees 1,250 and go down rent of 250 and sales expenses of rupees 500. Now still remember that rule of joint venture where we have to prepare the limited number of accounts. So here we will not take carriage account, we will not take go down rent account, we will not take sales expenses account because we have to prepare limited number of accounts. So to prepare limited number of accounts, we will collab all this. We will take this all together under joint venture account. We will debit the joint venture because I told you whenever there is any expense, you have to take joint venture. Okay, whenever expense increases, you have to debit joint venture. So the entry would be, see, joint venture account debit 2,000 because in total this is 2,000. 1,250 plus 250, that is 1,500 plus 500, that is 2,000. So joint venture account debit 2,000. 2,000 is being debited, that's the expense. Okay, you can write in the narration being expenses incurred on carriage, go down rent, sales expenses. You can write your narration on your own. Okay, so joint venture account debit 2,000, you will debit 2,000, joint venture account debit 2,000 to joint bank account 2,000 because here expense is increasing, so joint venture account debit, and joint bank account is credited because here the bank account, the asset is decreasing, we are making the payment. So the payment will be done from joint bank account, and since it is decreasing, so you have to credit it. Simple, right? Okay, then the next entry would be of sales. See, we have sold goods of 28,000, right? Sales 28,000. So all the goods were sold for 28,000. Then in the normal accounts, it will be cash account to sales. Yes, because cash is coming in and the sales is a revenue. So if revenue increases, you have to credit. Yes, 28,000. So cash account to sales. But here we will not open sales account because here we have to prepare the limited number of accounts. So we will not open the sales account. I told you, whenever there is any revenue, credit the joint venture account. If there is any expense, debit the joint venture account. All right, remember this rule in joint venture: whenever there is any expense, debit joint venture. Whenever there is any revenue, credit joint venture. All right, here there is sale, this is a revenue, so we will credit the joint venture. So now the entry would be joint bank account debit 28,000. okay, because the bank account is increasing, the asset account is increasing by 28,000 because we have sold the goods, so the cash is coming into the business, into the bank account. So 28,000 debit, and then to joint venture account. I told you, right, whenever revenue increases, you have to credit. So here joint venture account you have to take instead of sales. We cannot take sales account, all right, to maintain limited number of accounts. So we have to take joint venture account to joint venture account. It is opposite to expense. Okay, whenever there is an expense, you have to debit the joint venture. Whenever there is any revenue, increase in revenue, you have to credit the joint venture account. So joint bank account, cash is coming in, debit, asset is increasing, debit, and then to joint venture account, revenue is increasing, joint venture account is being credited, 28,000. Then the next thing that you have to do is, in the question it is given that the bill was met on the due date, the bill was paid on the due date. That means the bill is being paid, that means liability is reducing. Okay, before you created the liability, see, bills payable was created over here, it was credited, that means liability was increased over here. Okay, but now since the bills are being paid, now you have to reduce that liability. So to reduce that liability, here it was credited by 7,500, now you have to debit it by 7,500. Bills payable account debit 7,500. all right, bills payable account debit 7,500. Here the liability was created, here the liability is being exhausted, it is being paid. all right, so when liability decreases, you have to debit. When liability decreases, you have to debit. Bills payable account debit 7,500, and then the payment is made from joint bank account, so it is decreasing, bank account is decreasing, asset is decreasing, so you have to credit 7,500. Simple, right? Okay, now after the bills payable entry, everything is over. We have passed all the entries: purchase entry, expenses entry, sales entry, and also the bill payment entry. Now the joint venture is coming to an end. So now joint venture is coming to an end, so now we have to check whether the joint venture is in profit or loss. If it is in loss, then that loss will be bared by these two persons, the co-venturers, and if it is in profit, then that profit will also be shared by these two persons, okay, the co-venturers Amit and Sumit. Now how to check the profit? See, it is very simple to check the profit. You just have to see the amounts. Now what is the joint venture account? Joint venture account is a nominal account. On the debit side, it signifies, debit side, all the expenses, and on the credit side, it shows all the revenues. So if the credit side of the joint venture account is more, that means we are in profit, the joint venture is in profit. If credit side is less and debit side is more, that means it is in loss. So you just have to see the joint venture amount. See, the first joint venture word is over here, joint venture account debit 20,000. So the expense has been increased by 20,000, okay, 20,000. So add all the expenses, so 20,000, and then you can see one more joint venture over here, that is 2,000, right? 2,000. So add that plus 2,000, so it is 22,000, and then there is one more joint venture. No, there is no more. Okay, only two joint venture are there, that is 22,000. Now you need to subtract with the credit amount. See, the first credit of joint venture is over here, that is 28,000. Only one is there, 28, joint venture account 28. So subtract it with 28,000. So you get 6,000 profit. Okay, because credit side is more by 6,000. Credit side is 28,000 and debit side is 22,000. So there's a difference of 6,000. So that 6,000 is the profit, and that will come over here. Since debit side is shorter, so it will come on the debit side. Joint venture account debit 6,000, because debit side is shorter, right? We have to balance it. So 6,000 will come on the debit side, and then to whom this 6,000 will go? It will go to Amit and Sumit. Okay, 4,000 and 2,000 in their profit sharing ratio. Their profit sharing ratio is 2:1, right? So share it in that ratio. See, 6,000 into 2 divided by 3, that is equal to 4,000. So 4,000 will go to Amit. Okay, and then 6,000 into 1 divided by 3, that is equal to 2000. So 2000 will go to Sumit. So this is how you need to calculate the profit by comparing the debit and credit amounts of joint venture. And then if credit side is more, it is in profit. If debit side is more, that means it is in loss. Okay. And now since here it is profit, so the debit side is shorter. So it will come over here. Joint venture account will be debited and to Amit's account and to Sumit's account, because their capital accounts are increasing over here because profit is going to their capital accounts. Okay. So 4000 and 2000 will go to Amit and Sumit, and this is the profit. So this is how you pass the profit entry of joint venture. And then after the profit entry, now we have to find out the balance in the co-venturers account, Amit's account and Sumit's account. Now I have already taken 14,000 and 7,000 over here. But how did I do that? How did I get 14,000 and 7,000 balance? See, it is very simple to calculate the balance in the co-venturers account. What you need to do is you need to compare the debit and credit columns of co-venturers account. See here. At first, in the beginning, to Amit's account and to Sumit's account came, right? The contribution of capital. So their capital account increased by 10,000 and 5,000. It was credited. And then again, Amit's and Sumit's account was credited over here. Here, due to the profit, they got the profit, so their capital account again increased by 4,000 and 2,000. So now there is this much amount in Amit's account. There is 10,000 plus this 4,000. So 14,000 amount is there in the capital account of Amit, and in Sumit account there is amount of 5,000 and here 2,000 profit. So total 7,000 amount is there in Sumit's account on the credit side. Okay, on the credit side. So on the debit side there is nothing. On debit side there is nothing. It is zero. See, there is no debit amounts of co-venturers account. See, only credit is there. So entire you have to take on the balance. See, 10,000 and 4,000. So there is a shortage of 14,000 on the debit side in Amit's account. So you have to take that balance. Okay, so Amit's account will be debited by 14,000 and Sumit account has the balance of 7,000. See here, 5,000 plus 2,000. So on the debit side there is nothing, zero. So you have to take 7,000 on the debit side. Now they are withdrawing the amount from their capital accounts. So their capital accounts are decreasing. Okay, their capital accounts are decreasing. So I have debited their capital accounts. Amit's account debit, Sumit's account debit. Their capital is decreasing because they are taking the money to their home. They have completed the business. The joint venture is coming to an end and they have made a profit and they have earned 4,000 and 2,000 profit. They invested 10,000 and this guy invested, Sumit invested 5,000. Yes, 10,000 and 5,000 they invested. Now they are taking back 14,000 and 7,000. They have earned 4,000 and 2,000 profits. Now they are taking back 14,000 and 7,000. So now from where this money will come? Of course, this money is in the bank account. The bank balance will get decreased because this money was in bank account. Now they are taking that money in cash form to their homes. So now their account will get debited and joint bank account will get credited because the balance is decreasing. The asset is decreasing because the bank balance is getting to zero. So 21,000 will be credited. Okay, you understood, right? How this 14,000 and 7,000 came? All right. And it's very simple. Amit's account debit, Sumit's account debit because capital accounts are decreasing. They are withdrawing the amounts and bank account is also decreasing because the balance is going out. It is going to their home. So bank account will get credited 21,000. So this is how you pass the last entry. You have to find out the balance in the co-venturers account. And if they are going to receive the money, then you have to give to them. If they are going to make the payment, then you have to take the money from them. Okay. So this is how you pass the entry. All right. Now let's see the ledger account. This was easy, right? Okay, now let's see the ledger accounts. See, in joint venture, you have to do all the ledger accounts together. Okay, you have to do it simultaneously. All right. So first draw all the formats and then do it all together. See how I do it. At first, what happened? At first, this Amit and Sumit, they contributed capital of 10,000 and 5,000 into this joint venture. So due to this transaction, what happened? Due to this transaction, the capital account of Amit and Sumit increased. All right. And also cash came into the business. That means cash came into the joint bank account. So joint bank account increased. So whenever joint bank account increases, what you have to do, you have to debit the joint bank account. And why it increased? It increased because of the contribution of Amit and Sumit. So 10,000 and 5,000. Due to these contribution, joint bank account increased. All right. So this is how you need to do the posting of the contribution of capital. And then immediately you have to do the cross posting. See here, Amit's and Sumit's account has come. So immediately in the co-venturers account, you have to take it here on the credit side because the capital account is increasing due to the contribution of capital. So by joint bank 10,000 and 5,000. All right, this is the cross posting. See, to Amit, to Sumit, here it will come by joint bank because this is in bank account, right? So by joint bank account 10,000 and 5,000 in Sumit and Amit columns. And then what happened? And then there was purchased goods from Arish worth rupees 20,000. So that purchases is an expense, right? So here we open a joint venture account. So that will come here in the joint venture where we record all the expenses on the debit side and all the revenues on the credit side. So it will come over here to Arish account 20,000 credit purchase, right? So it's an expense. So 20,000 will come on the debit side. Joint venture account will get debited. Okay, joint venture account debit because of the expense of this Arish. We have purchased goods from Arish 20,000. All right, and then what happened? And then you see over here we have paid 12,500 to Arish. Yes, we have paid 12,500 to Arish, and that payment is done from the joint bank account. Yes, always all the payments will be done from the joint bank account. So immediately you have to go to the joint bank account. See, by Arish account 12,500. If payment is being made, that means joint bank account is getting reduced. The payment is done, right? So it is getting reduced. So credit because of Arish, the payment is done to Arish. So it will come by Arish account 12,500. And then what happened? And then if you see, there were expenses incurred. The carriage to 1250, go down rent 250, and sales expenses 500. Yes, rupees 500. So if expense increases, you have to take it in the joint venture account. If expense increases, you have to debit the joint venture account. Okay, so it will come over here to joint bank account because we are making the payment of all these expenses from the joint bank account. So you have to take to joint bank account. We have to minimize the accounts, right? So we will not take carriage account, go down rent account, sale expenses account. No, we will not take that because we have to maintain the limited number of accounts. So we will just take to joint bank account. This is the only thing common in these expenses, right? We have made the payment through the joint bank account. So we will take it all together 2,000. Then immediately you have to go to the bank account. So bank account is getting reduced, right? You have made payment from bank account. So it will come over here by joint venture. Bank account is getting reduced. So credit because of the expenses by joint venture account. Expenses 2,000. You need to write in the bracket, okay, because it is easier to understand. So 2,000 here, credit. Simple. And then what happened? And then there was also this bill, right? Bill payment was met on the due date. So the bill payment was also done through the bank. So the bank account will get reduced because the payment is done from the bank. So same thing, joint bank account will get reduced because the asset is decreasing. So it will come because of bills payable by bills payable account 7,500. Easy, right? See, joint bank account is decreasing, right? Joint bank account is decreasing because of the payment made to this bills payable to the Arish. So 7,500 will be credited. Simple. And then what happened? And then there was sales of rupees 28,000. Now this sales is revenue, right? Income, right? Sales is income. So whenever there is sales or revenue, you have to take it on the credit side of joint venture account. Joint venture account will be credited. Whenever there is revenue, it will come on the credit side, okay, by joint bank account, because whatever receipts we get, whatever money, whatever income we get, that income will directly go to our joint bank account. So it will be by joint bank account. Joint venture account is being credited because of joint bank account, okay, because of sales, the money is coming into the business. So 28,000. And then immediately this cross posting you have to do into the joint bank account. See here, to joint venture 28,000. This is the cross posting by joint bank account. Here it is to joint venture account because this is a joint venture, right? So it will come over here to joint venture account 28,000. And then what happened? And then everything is over. See, everything is finished. Purchases, expenses, sales, everything is over. Contribution of capital, bill payment, everything is over. This partly payment also is done. And then you have to find out the profit or loss made by the joint venture. So this is revenue side, this is expenses side. So if revenue side is more, that means there is profit. If expense side is more, that means there is a loss. But here if you see 28,000 and here 20,000 and 2,000, that means this side is more by 6,000. So 28,000 you have to write on the both sides and subtract this 28,000 from these two, 22,000, you will get 6,000 profit. And then you have to share this 6,000 profit in the ratio of 2:1. I have shown this while doing the journal entries, how I got this profit, and then 4,000 and 2,000 will go to Amit and Sumit. That is the profit and loss. This will come on the debit side because debit side is shorter, right? Expenses are short, so you have to take it on the debit side to profit and loss account. This is similar to trading and profit and loss account. We take all the expenses on debit side and all the revenues on credit side. It's very simple. Then immediately this profit will go to the co-venturers account. This will go to the co-venturers account. So it will come by joint venture profit. By joint venture profit 4,000 and 2,000, because these profit are for the owners, right? For the co-venturers. So this will go to the Amit's and Sumit's account, that is co-venturers account. It's like partners capital account. So you have to take it over here, 4,000 and 2,000. And then you also need to balance this account too. So you will take 14,000. See here, 10,000 plus 4,000, it is 14,000, and 5,000 plus 2,000, 7,000. And then you have to take it over here, the balancing figure to joint bank account 14,000 and 7,000. This is the balancing figure. Okay, here 14,000, there is nothing over here, right? So you have to do the balance. So 14,000 and 7,000 will be the balance, and then this balance will immediately go to the bank account. See, in the bank account you have to take it over here by Amit's account balancing figure and by Sumit account balancing figure. See, at last this joint bank account will get tallied. Okay, so we have done this, Arish joint venture everything. So 12,500 plus 2,000 plus 7,500, how much it is? See, 12,500 plus 2,000 plus 7,500, and then add these two. We got these from here, from co-venturers account. See here, 14,000 and 7,000. So add that, how much it is? 14,000 plus 7,000 is equal to 43,000. See, 43,000. And here also you check, 10,000 plus 5,000 plus 28,000, which is equal to 43,000. So the joint bank account will get tallied. It is very simple. You just have to do the cross posting everything simultaneously. All right. Okay, so we have done the joint bank account, the joint venture account also finished. We have found out the profit, and the co-venture account is also over. We have found the balancing figure, which is called as the two joint bank account. Okay, because the payment will be done from the joint bank account. Simple, right? Bank account is increasing, you have to debit. If bank account is decreasing, you have to credit. Simple. And co-venturers account is also very simple. If it is increasing, you have to credit. If it is decreasing, you have to debit. So it's very simple. Joint venture account is also very simple. Take all the revenues on the credit side and take all the expenses on the debit side. Simple, right? Okay.